about, 517. The stock's at about 503 or so. Similar case with most names. Market breadth is also a little negative. Declines more than advances is what we have. But the earnings season is, of course, upon us. And today we are looking at what we can expect from the steel space, which will report numbers. This is our special segment, Quarter Se Quarter Tak. Nigel is standing by the big wall with exactly that. Nigel, over to you.
Well, that's right. Steel results, they could see a bit of a slowdown. Remember, the last couple of quarters have been quite good and they've been showing a strong showing out there. The key reasons are input costs like coking coal. They have spiked, though the major impact will come in the second half of this fiscal. Domestic demand as well saw some seasonal weakness, which will result in higher focus on exports. And long steel prices, well, they were soft because construction activity was limited. Now, steel companies have disclosed their operational updates, and that gives us a bit of a cheat sheet. For Tata Steel, the Indian as well as the European deliveries took a hit owing to lower exports, as well as in the base year, there was some liquidation of inventory. JSW Steel's production number, well, they jumped. It was aided by contribution coming in from Bhushan Power and Steel, as well as JSW Ispat products as a special steel, as well as the US operations. And JSPL, well, they delivered some of the best numbers that we've seen in a single quarter, more than 2 million tons odd for the first time ever. That was aided by exports as well. Now, turning to expectations coming from Edelweiss itself on the EBITDA front, for Tata Steel, they expect an improvement led by a turnaround of the European operations, and as domestic business will gain from higher prices, which will offset the higher coking coal cost. For JSPL, though, despite a sharp uptick in terms of volumes, the EBITDA is likely to be impacted because of higher iron ore costs. This, as the Sarda iron ore inventory that they had was exhausted in the past quarter. Additionally, JSPL sales mix well tilted towards longs, where pricing was rather weak. For SAIL, though, the EBITDA will get a boost because volume should jump up big time, close to 25% or thereabouts, though the benefits will be limited because of higher input costs. The key focus for SAIL will be debt reduction, as always, could be to the tune of nearly around 5 to around 6,000 crores. For JSW Steel, well, the EBITDA growth will be led by higher realization, reliance on exports, as well as stable volumes. Their overseas operations, well, the subsidiaries will continue to do well out there and continue to show improvement. Valuation-wise, we've been seeing this for the last many years. Well, SAIL as well as JSPL, they trade at a discount to the other couple of peers. Remember, this is on FY23 numbers. The key triggers then to track from here on will be the management commentary, the acceptance of the price hikes. Remember, price hikes have been pushed through. They need to be accepted. And also optimism that the worst in terms of the coal crisis as well as prices, that's behind them. And also focusing on the balance sheet, deleveraging out there can give these stocks some headroom to move up from here as well. Back to you guys.
All right. Thanks a lot, Nigel, for that. Well, Amit Dixit, the Director, Institutional Equities at Edelweiss, is with us. Amit, you heard what my colleague Nigel just put out. And on a valuation parameter, I mean, it looks like, as he was saying, SAIL and JSPL trading at a discount to peers. But what would your pecking order look like, both in terms of earnings growth as well as valuation headroom?
Yeah, hi, Sonia. So we are optimistic on Tata Steel. Tata Steel is our preferred pick in the space, followed by JSPL and SAIL and then JSW. So this is our pecking order. And this quarter, as Nigel highlighted, that, things are, the earnings momentum that we have been accustomed to seeing over last 3 quarters, that would slow down a bit, mainly because of prices nearly flattening out, particularly in long segment. And there would be cost headwinds also, particularly in case of coking coal. So you could see coking coal cost higher by almost $25 to $50, depending on the company. Then iron ore cost, particularly for domestic non-integrated players like JSPL and JSW Steel, is likely to go up. Now, why we prefer Tata Steel though? Because European business, after a long time, is going to perform very well. So these spot prices that you would have seen, these prices would progressively get reflected in contracts. And therefore, we expect EBITDA per ton of European division to be around $238 compared to $90 odd dollars last quarter. And that would provide essentially the fillip to Tata Steel numbers. And going ahead also, we believe that at least over next 3-4 quarters, these high contract prices should stay. and therefore Tata Steel Europe stands to gain. And then in case of Indian operations, well, you are nearly 35% integrated on coking coal and 100% integration on iron ore. In an environment where raw material prices are skyrocketing, I think this should definitely help.
I mean, just stay with us. Look at the market, though. We're down 70 points now. I mean, which is basically about 170, 180 points off the highs of the day. Just completely flipped. But, 60 points now on an index of 18.5 is 1/3%. So, it's not a large move, but it is what it is. And we've had so many instances where, the market tries to sell off and is bought back aggressively. I mean, there is always that, that buying support which has emerged. I mean, at least that's the evidence now for the last almost 2 years or so. A single day, very large cuts, very far and few in between. For now, it's a bit of a turn that we are seeing. Market breadth is also flipped. It's 15 minutes, 20 minutes back, it was mildly in the negative, the breadth of the market. It's now 1,400 stocks lower and about 500 stocks higher. So this is across the board in the market that we've seen a bit of pullback, bit of profit taking. Surabhi.
No, absolutely, Prashant. And this is not something we can ignore. This is not a normal fall. This is not about some profit taking in one sector and a little bit of a churn. It is all encompassing. It's across the entire market. It's on stocks from the metal space that we've been discussing throughout. It's on a major name like ITC, which anyway started weak. And this is not something that's playing out across the region. Pull up Asia. Markets in Asia are holding up. They're all in positive territory right now. In fact, some of them are up over 1%. So this is not an Asian fall that's come in. Something has triggered profit taking across the board in the Indian market today. So this is unusual. We haven't seen this in the past many trading sessions. Let's see if the dip gets bought. But the manner in which this fall has come in, it's not very comforting, to say the least. Amit, so I just want to go back on the outlook on prices here in India. The domestic side of the market. How much of an increase do you think the companies will be able to push through? Because, I guess Indian prices are still lower compared to the FOB value or, of course, to international prices. So how much more?
Well, that's an interesting question, because always a price increase is met with the concerns of inflation from every quarter, particularly when, no raw material is being spared. So while our costs, our steel prices are the lowest in the world, and still there is a sufficient headroom of around 15 to 20% compared to import parity price. And we have seen that in this month, in last 15 days, there is an uptick in the traders market. I think that should get reflected. Ideally, I would see, based on the trader channels and, my channel checks, I would expect another 2,000 rupees kind of price hike going forward. But, that also won't be sufficient to actually offset the price of coking coal, which even if, all the Indian companies, they blend a lot and they also have good amount of PCI injection. But I would expect that, coking coal cost for all the companies would be up by almost $100 to $120 going ahead in Q3. And there we see a crunch on the spreads because prices are still not at that level wherein, these high coking coal prices will be absorbed. So Q3 would be something that could be an important point to watch out for. I mean, again, I'm not saying even for a moment that, you will go back to those days when EBITDA per ton used to be, in shambles. This is not the point. The point is that a very high EBITDA per ton that we have been accustomed to seeing in Q4 or FY21, Q1 FY22 and Q2 FY22, unless and until, price hikes happen, which in the present environment seem a little bit daunting, would have pressure on the spreads.
Okay, so expect pressure on the spreads if prices don't continue to rise. Got that point. I mean, thank you very much. And thank you, Nigel, for putting things in context. Now we are prepped up for the earnings season on the metal side of it, the ferrous metal side of it. With that, we will take a very quick break. On the other side, an exclusive interview coming up. Former chairman of the State Bank of India, Rajneesh Kumar, speaks about his newly launched book, The Custodian of Trust, a banker's memoir. More about this after the break.